Mutual funds have long been a popular investment choice for individuals seeking to grow their wealth over time. They offer a diversified portfolio managed by professionals, making them an attractive option for both novice and seasoned investors. Investors spend a considerable amount of time picking the best funds. This selection is based on several parameters. These include return expectation, risk tolerance, investment horizon, expense ratio, past performance, and assets under management. While much emphasis is placed on when to buy mutual funds, knowing when to sell them is equally crucial. Generally, investors are not very clear about how and when to exit or sell the same funds. More often than not, they end up not exiting. This leads to a cluttered portfolio or a zoo of different funds. Making the decision to sell your mutual funds requires careful consideration and an understanding of various factors that can impact their performance. In this video, we will explore the question of when should you sell and when should you hold your funds, exploring key indicators and strategies to help you make informed decisions and optimize your investment portfolio. Hi, I am Pratap Narula, investment consultant and educator, and if you like my video, please put in your likes and subscribe to my channel. Also, ring that bell to get all future notifications from this channel and put in your feedbacks and comments. Further, put in your questions in the comment box and I shall get back to you on the same. The last few years have shown a series of ups and downs in the financial markets. Because of that, you may have seen some scary numbers when you've checked your portfolio. But it doesn't mean you should react. Experts' advice to long-term investors remains the same. Turn off the news and stick with your plan. Staying invested in mutual funds even during market highs allows their wealth to grow and compound wealth, and thereby takes them nearer to their envisioned goal. On the other hand, if investors redeem their mutual fund investment only to re-enter at a lower level later, they may miss out on future gains. This can create a hurdle in their wealth creation process. Timing the market is futile, especially for those investing for the long term. No one can accurately predict if the market has bottomed out after a correction or whether it will keep rising after reaching a peak. So there is a high probability that investors' bets may not pay off as expected. Thus, long-term investors should not be affected by market highs and lows. But don't interpret that as a recommendation to never change your holdings. There are various signs which indicate that it might be time to sell a mutual fund and where liquidating funds may be advantageous to you. Knowing whether to hold on to a fund or sell it can be a challenging decision. There is no universal one-size-fits-all strategy for selling a fund. Instead, it's up to the individual investor's investment strategy based on many factors, including their risk tolerance, time horizon, and financial goals. Also, things don't always happen the way they should. The same is true for mutual fund investments, and hence one needs a well-sounded exit strategy. Let's look at the variables you should think about before selling your investments. The first factor to be considered while you're deciding whether you should sell or hold your mutual funds is achievement of goals. People often invest in mutual funds to save money for a specific purpose like buying a house, children's education, retirement planning, and others. Investors who have been investing regularly would have likely accumulated a sizable amount over a period and fulfilled their goals. Such investors may consider selling their funds and booking profits to protect their capital from market uncertainties and volatility. If the goal for which investors have invested is less than about 2 years away, it is time to start gradually redeeming investments in equity mutual funds and shift to less risky avenues such as safely managed debt mutual funds or fixed deposits. Suppose you had a financial goal to save Rs 40 lakhs for your daughter's graduation by the year 2025. Thanks to the run-up in the equity markets, you have already reached Rs 43 lakhs by August 23. Your goal, therefore, has already been achieved before time. This should be one reason to consider reducing risk and exiting some equity funds. Money growing at a lower rate is fine, as you have already achieved your target and have the option of meeting your goal without exposing the accumulated capital to any further risk. Doing this is especially critical for important goals as these are non-negotiable. Moving on to the next factor, which is consistent underperformance. If your scheme is underperforming for a long time, you should consider selling your investments. However, before exiting any of your investments, it is important to compare the performance of a mutual fund scheme with its peers and the benchmark. If the fund in question has consistently underperformed most of its peers and the benchmark across various market phases, then it may be time to redeem it and replace it with a better alternative. This approach helps you get a clear picture of what exactly is wrong with your fund. When compared with the toppers of the category, your fund may not deviate by strong percentage points. By employing this technique, you may determine if the scheme is performing poorly or the market or that particular category as a whole is facing a hard patch. This, in a way, justifies the reason for your fund's underperformance, and you may not want to sell it immediately. Thus, always look for comparative analysis to get a holistic view rather than just a standalone approach. The third factor to be considered is fundamental changes in a fund. When you buy a mutual fund, you go through the fund's objectives, asset allocation, and risk exposure to choose the one that suits your financial goals. At times, the fundamental attributes of a mutual fund scheme may undergo changes, such as a change in investment philosophy, strategy, style of the scheme, changes in scheme category, etc. While most mutual fund investors prefer to invest and forget, not many know that the fund house can change a fund's investment objectives at any time. When a fund house does that, it needs to give investors an option to exit the scheme without paying any exit load. Such changes can result in the scheme following a more aggressive or conservative approach and may no longer be in sync with the investor's risk profile and investment objective. In such a case, investors may consider selling their mutual fund units and invest in a scheme that aligns with their investment objective. For instance, you could have invested in a small cap fund because you only wanted to expose your money to small cap firms. However, if the fund management starts buying large cap stocks, you need to start seeking to sell so that you can stick with your preferred investing approach. Another very important factor to be reviewed on a regular basis is portfolio rebalancing. Sharp movements in the equity market often lead to an imbalance in the investment portfolio from the set asset allocation. A common reason to sell funds is to adjust a portfolio. Balancing returns your portfolio to its target asset allocation. Some investors do it on a regular basis, others do it when their allocation shifts by a certain amount or a certain percentage. Let's say you have a long-term goal for which the chosen asset allocation is 65% equity and 35% debt. After a few years of regular investing, your goal-related portfolio becomes Rs 25 lakhs with Rs 19 lakhs in equity funds, that is, allocation of approximately 75% to equity. Now, to rebalance your portfolio back to 65% equity, you need to sell a portion of your equity fund holdings. How you pick these funds will depend purely on performance. You can also sell a portion of the fund that has an uncomfortably high concentration in your overall equity portfolio. Or, if you have multiple schemes from the same category and they are overlapping, you can exit a scheme or two to reduce the overlap and have just one fund per category. There are many other reasons due to which a portfolio might become unbalanced or inappropriate for your investing goals. This could be due to a life event such as a marriage, divorce, retirement, or merely an accidental concentration of capital in one sector. Change in investment preferences is again a factor that cannot be overlooked. An individual's personal circumstances may undergo changes over the years. This may result in change in priorities, which may induce investors to revisit their existing financial goals and investment approach. Investing is a lifelong journey. You might be looking at higher returns in your 20s and be willing to take higher risks. But in your 40s, you might be satisfied with lower returns provided the risks are low too. Hence, you might consider redeeming the high risk mutual funds purchased in your 20s and replacing them with medium risk ones. Risk and return are effectively two sides of the same coin. Higher risks correlate with stronger potential returns. At the same time, lower returns correlate with safer investments. Together, they define how investors choose their investments in the marketplace. Factor number 6, financial emergencies, is a situation which you might face at any stage of your life. No matter how prepared you are for the rainy days, there can be an emergency situation when you might need to sell your mutual fund investments from the long-term portfolio. One of the benefits of investing in a mutual fund is that your investments are liquid. This means that you can easily redeem them if you are faced with an emergency. In such situations, you don't need to think about when to sell your mutual funds, but leverage the liquidity and redeem your investment. However, do keep in mind that some funds may take up to 3 working days to return your money to your bank account. Also, keep in mind that selling mutual funds should be seen as a last resort, and investors may first consider utilizing the corpus parked in the form of an emergency fund. Change in the fund manager is another factor which might affect your exit strategy. The fund manager plays a pivotal role in the performance of an actively managed mutual fund. When the fund manager changes, the investors must start tracking the performance of the fund closely. While some changes can result in an improvement in the fund's performance, there can be times when this change has a detrimental effect on the fund. If you are not comfortable with the approach taken by the new fund manager or observe any negative effects on the fund, then it might be the best time to redeem mutual funds. Even though this isn't a blatant sign that you ought to sell your fund's units, you should exercise caution in this situation. Since fund managers are crucial to a scheme's success, whenever a change is made, you should always look into the background and track record of the prospective fund manager. You can use this to decide if it's time to start thinking about leaving the fund. Factor number 8 is change in management. Sometimes it may make sense to sell a fund if an AMC or asset management company has been acquired or merges with another. Many times the fund price can rise dramatically if it is acquired for a significant premium. As a result, investors may sell their investments after the merger. However, it's important to determine whether the company's fundamentals are better after the merger or acquisition, and if not, it may be time to sell and put the money elsewhere. If there is a change in management, it would be beneficial to keep a track of the performance of the fund. It is usually doubtful that the goal of the scheme would now be different from the one you first invested in. If the combined plan's performance remains positive, then stay invested. If it is negative, switch to a new comparable scheme offered by a different AMC. The last factor to be taken into consideration is tax benefits. If your fund has incurred considerable capital loss, then the income tax authorities allow you to offset it against capital gains. Some investors choose to redeem mutual funds that have a capital loss to enjoy tax benefits on the redemption of funds that offer capital gains. This is not a recommendation but just an observation, as many investors take this route. This needs to be calculated carefully, and you must go through all the terms and conditions specified by the IT authorities before making this decision. I would like to conclude by saying that there is no one correct answer to when one should exit a mutual fund. While deciding whether you should sell or hold your mutual funds, there are a number of aforementioned factors that could play a role in your decision to ensure that it aligns with your financial goals. Thank you for watching this video, and once again I would request you all to put in your likes and subscribe to my channel.